In this week's update, what to expect in 2023, how to profit from it, and gold breaking hard to the upside. My name's Garry Davis, and as always, this is general advice only, and please remember to like and subscribe to the video. All right, let's start with a market perspective, but look, just before I do that, long-term watchers of this video will know that I'm fundamentally bullish, and to my way of thinking, that's always been the best way to be because markets are in long-term uptrends. And over the last 2 to 3 decades, the Fed has accommodated stock markets, and markets have had a tendency to price in 6 to 9 months ahead of what they are expecting coming. And major lows, therefore, have always formed well in advance of the economic data or the news. Now, the Fed and other central banks have now signalled that that era is finished and a new era has started where they're going through monetary tightening, they're raising interest rates, and so for a period, my fundamental outlook for most of the market has shifted. And it's shifted since December 16 when the Fed had the opportunity to to ease off, take their foot off the pedal to a degree, but they didn't. And clearly they've followed up on that ever since. So one has to assume that economic conditions are going to get tighter and tighter for a while. And under the circumstances, that has raised the odds of the markets, or the indices, heading down. So not only fundamentally is it likely that indices will head down, but also technically, as we'll see, the indices are still in downtrend. It's the only way that you can interpret it at this point in time. And so the fundamentals and the technicals are lining up, and that always doesn't happen. However, parts of the market are going to be quite different, and you've only got to look in 2022 to what happened with lithium, what happened with the US energy. There were bright spots. There weren't that many of them, but there were some bright spots. And so that's the part that I'm focused on. So I just want to be very clear about where I'm coming from. So the American CPI came out and was pretty much as expected. There's a bit of debate about how the numbers were interpreted, but it was pretty close to what was expected. And so the market chose to react positively. And that always happens, of course, when markets are coming back from being oversold. And so that wasn't terribly surprising. But when you step back and take a slightly bigger view, the inflation rate is still far too high. It's 6.5%. The Fed wants to get down to 2%. Other economic data is mixed, some pointing to economic conditions that might be okay, others pointing to economic conditions that may fall off a cliff. So it's a very mixed picture, but I think the biggest thing is that the Fed is committed to getting inflation down, and that is still way too high. And so therefore it's more likely that the Fed is going to continue on this path that they started last year. Now let's have a think about the US market sentiment. The indices remain in downtrend, but they are approaching the upper boundaries. So we're in the midst of a bounce, and what that says to me is that it means the probability of a rollover is higher. We'll come back to those charts. We're seeing quite large divergences on both a sector basis and also on an industry group basis. So some doing well and some doing not so well. And then even within the industry groups, we're seeing even larger stock divergences from stocks. There are stocks that are extremely positive and there are stocks that are extremely negative. So there's just massive divergences all over the place. I just want to show you one chart quickly. So this is JP Morgan. So the US earnings season started on Friday night with the big banks, as it always does. And you can see JP Morgan, the price gap down. So it had been showing some strength since the lows in October. The price gapped down quite dramatically on the open, but then traded up very strongly. And that's probably the biggest positive candle we've seen within the field of view. And the reason was that the earnings came out at $3.57 versus an expected $3.08. And so that was the positive that the market ended up running with at the end. But what the market reacted to initially was that they made a $2.3 billion provision for the expected loan losses. And it's the same across the board with the other big banks as well. And there's something like, I can't remember the number now, but it's a massive number of provisions for expected loan losses. And the chairman and CEO, Jamie Dimon, said that the US economy is still strong, but don't know the ultimate effect of all these things. Geopolitical tensions, which are obvious, the vulnerable state of energy and food supplies, persistent inflation and higher interest rates, and unprecedented quantitative easing. Unprecedented quantitative tightening. For so many years, I've talked about quantitative easing. And the other big banks that reported, their results were similar. So that's the start of earnings season. That's the first shot across the bow, and the market has reacted in somewhat mixed fashion. But what's important will be the follow through next week. And next week is a very interesting week because it's options expiry as well. So anything can happen in that week. Let's look at the Australian market setup. Resources, the unquestioned leader of the Australian market. And the supply and the demand outlook for most resource products remains highly compelling. Nothing has changed in battery materials at all. There's lithium's going through a bit of a retracement, which is really just the cycle. I mean, stock prices don't go up and up and up in a straight line. They advance 2 or 3 steps and then they come back a step or two, and then the next advance starts. And with lithium, we're going through that consolidation process at the moment. So lithium had a fabulous run in 2022. We're going through a pause, but lithium will be back. And it's easy when you're going through that retracement pause to think that it's all over. And there's been plenty of headlines saying that we've seen the peak in lithium prices, and that may be the case. We may never see prices go beyond the levels they set last year, but that doesn't mean that the price of lithium stocks has peaked, by no means. Gold may become a leader, and I'll come back to that, certainly looking much, much better. Copper and uranium are starting to gain favour as well. I'm talking about the stocks themselves. And don't forget about graphite. Price gains are significantly overdue in graphite. And in each one of these areas, I've got a basket of watch lists that are covered in Portfolio Analyst on a periodic basis. So staying right on top of where all the opportunities are. So what to expect this year? Well, the mega trends are going to continue because they don't get thrown offline by Fed policy. So that's going to continue. And the mega trends in technology, whilst technology stocks are looking pretty sad at the moment, the mega trends are still continuing. The process of stock prices coming down is about valuation. It's not that the mega trends aren't continuing. They are, and eventually will come down far enough that we'll reach a valuation point that is low enough, and then the technology stocks will be back. So we've still got a bit of a way to go on the valuation adjustments yet. I think volatility, it's reasonable to expect that volatility is going to be even higher, which is absolutely fine by me, because that means that we get larger peaks and troughs, and we get there more quickly, and that just provides opportunities for taking advantage of those moves. So how do we go about making money from this? Well, my approach has been, and different people will come up with different scenarios, but my approach has been in the face of uncertainty, is to hold smaller core positions for the long term. The stocks that I'm really committed to, that I have the utmost confidence in, but I'm just holding a smaller long-term position, holding higher levels of cash for much of the time, and then only cashing in and using that cash when we get to those oversold extremes. And then when we get to the overbought extremes, then take the profit off the table and retreat to a higher level of cash again. So for me, it's a year of being more active, using weakness and strength to advantage, just play the backwards and forwards. And I don't see any reason why 2023 can't be an outstanding year. And another thing that repeatedly comes up in questions to me is people that want to own, they've got their heart set on owning a certain stock, and they just want to find a way to get into that certain stock. Well, I really think you need to lose the need to own a certain stock. Involvement in the stock market, to my way of thinking, is about making money. So you just buy the stocks and the opportunities that help you make money. It doesn't really matter what stock it is. So anyway, that's always been my approach to the market. The American market, the S&P gained a pretty healthy 2.7% on the week. There are numerous industry groups, so there's 200 odd industry groups in America, and there's quite a few of them that are trending nicely higher. So even though the indices are heading down, and XLC Communication Services is one of them, and one of the majors in that area is a company called Disney that I'm sure everyone's heard of, and that whole sector is shaping up quite well. So is a productive sector to go and look in. But as I mentioned a few slides back, banks are making huge provisions for loan losses, and that just makes sense. It's almost certain that those loan losses are going to happen. And so that's going to be a drag. Making a provision for a loan loss hits the bottom line. And so the bank earnings are going to come down over time, and you'd have to expect that this earnings season is going to throw up a lot of companies that are struggling. And my understanding is that valuations are still too high for what is coming. The US dollar index continues lower. So the market is certainly betting that interest rates are not going to go up as high as they are. The 10-year yield is still trending down. We're at 3.5. The VIX is also getting to a pretty complacent level. We've hardly been under 20 for the last year, and now we've just broken below 20. So that, with the fact that the index is now at the top of a downtrending channel, has increased the odds, to my way of thinking, that we could roll over. The 10-year 2-year spread is at negative 0.73, and it's been holding in that area for quite some time now. So that's clearly saying recession coming. Okay, let's take a look first of all at the S&P. So you can see this is the clear downtrending channel that we've got. We've been bouncing from one side to the other, and we're right at the top. So when you couple that with a VIX that's indicating that people have perhaps turned a bit complacent again, increases the odds. So, that's all you can say. You can't say that this is going to turn down, because it could equally turn up and break these highs. But the probability of this turning down is now much, much higher than it has been since we were here, or we were here, or we were here. So that's the position of the index. And if we look at the spread charts, this is the Nasdaq versus the S&P. Nice turn up from the Nasdaq last week, but clearly we're still in downtrend, as we have been for some time. So nothing has really changed there. This is small cap growth versus small cap value. It's just flatlining at the moment, nothing of interest there. This is on a weekly chart, large cap growth versus large cap value, clearly still in steep decline. So we're still getting a rotation of money from growth into value, and that hasn't changed. Semiconductors versus the S&P. maybe just starting to form a bit more of a base. So that would be a real positive if we can get up above here, but there's still plenty of work to be done on that one yet. Consumer discretionary versus staples has been getting smashed around a lot because of Amazon and Tesla. Amazon appears to have turned the corner to a degree, Tesla not so yet. Mid-cap growth versus the S&P looks pretty much the same as the small caps. And finally, this is large cap growth versus large cap value, and still clearly in decline. So that's what the spread charts are telling us about where the money rotation is going. Now, I just want to take a look at a couple of other things. This is the VIX over the last 6 months. So you can see we're now at the lowest level we've been in the last 6 months. Let's have a look at the last 12 months, and it's pretty much the same. So we're basically at 12-month lows. And it's been quite a long time since the VIX has been down. You've got to go all the way back to 2020, the January 2020, before the COVID crash, to see levels of the VIX down at this level. So this is not consistent with what's happening in the economy and with what the Fed and other central banks are doing. This is the 10-year Treasury. Let's look at this on let's look over the last 6 months. So we now would appear to be we're certainly forming lower highs. We haven't quite got the lower low yet, although I guess we did here. These lows here were below this one. But you've got to say that the probability is that this is tending to trend down, which would indicate that the peak in interest rates is closer than some might think. So that is not consistent with Fed policy. Just one of several inconsistencies we've got in the market. This is the wheat chart over the last 12 months, and the reason I put this up is because obviously the price of wheat can feed into inflation, as indeed does oil, as does natural gas. And so this one is looking much friendlier now towards inflation than what we saw up here when we had the invasion of Ukraine. And the final chart I want to show, this is iron ore, so we'll look at the Australian market in just a minute. And this is the reason that the materials sector in Australia and in turn the ASX 200 have done so well of late, and certainly outperformed the S&P 500 and the Nasdaq. So strength in iron ore has been a huge contributor. So I would caution against looking at the performance of the Australian index and thinking that all is well in Australia, because it's been largely influenced by this iron ore chart. All right, so moving to the Australian market, the Australian dollar 69, just a touch over 69, so we've got a bit of a bounce going on there. Our index was up 3.1 for the week, and as I showed, materials clearly the leader, but we are approaching all-time highs. So this is this is starting to be an area where the odds of turning over certainly get a bit higher. All right, I just want to look at the indices. So the US dollar, we've broken out, we've retraced, but the bigger picture is still that we're in uptrend. So the US dollar bottomed out in 2008, formed a slightly higher high in 2011, but has been trending higher since then. So it's unclear to me a lot of people seem to have strong opinions on the US dollar direction, but it's pretty unclear to me where it goes within the next 3 to 6 months. And just looking at the Australian dollar, so we've broken back below that breakdown level as the US dollar continues to fall. But I think the long-term direction for the US dollar to me is probably higher. Okay, so just looking quickly now at the ASX 200. So these are our all-time highs up here. So we're certainly back on the way towards those highs. But the real contributor, there's the materials. And materials sector also approaching all-time highs as well. Now just while I'm here, I'll take a look at gold and silver. Silver is trying very hard to break out. Hasn't quite done so yet, but gold certainly has. So you can see on a weekly chart, we've now gone through one resistance level, second resistance level, third resistance level, and it's gone through very, very quickly. So it's the speed of this rise. You know, there's only been in here 1 or 2 weeks of pause and hardly any downside. So we've gone, 1, 2, 3, 4, 5 very concerted weeks up in a row with very little in between. Yeah, that's a very emphatic rise. The next level comes in here at 2,000. And then, of course, the double top and the all-time highs up here at around 2075. So gold looking much, much better. If we look at it on a daily basis, you can see quite a nice move on Thursday and Friday. Looking at how stocks responded to that, gold stocks are going okay, but in Australia we've seen even better performance than GDXJ, that's for sure. So 1920 is where gold finished, and looking very, very robust. 2000 is the next level to get through, and then somewhere between 2060 and 2075 is the all-time highs. Now, if we convert that into Australian dollars, it did increase during the week, but not as much as you might have thought, because the Australian dollar went up and that just held it back. 27.78 is an incredibly healthy Australian gold price, but the thing to remember here is that cost of production for gold stocks, it has been rising quite significantly, and whilst there would appear to be a new bull market underway in gold stocks, and that's always a very exciting time. You can do extremely well in very short periods of time. And I'm expecting that we're going to see an increasing level of mergers and acquisitions in the gold sector in 2023. And part of the reason for that is almost survival, because the cost of production is really going up very quickly. And I saw a number a few days ago, which I'm struggling to believe, but I think it's probably correct. And that is that the average all-in sustaining cost now for Australian gold miners is now something close to $2,000 an ounce. The last time I looked, it was something more like $1,300-1,400. So I'm hoping that number is not correct. But there's no question that the cost of production is rising very, very quickly, and that's going to force a lot of stocks to get together, or for larger stocks to take advantage of the situation and swallow some of their smaller peers. So I think the position of the gold market is we've now moved very suddenly, very abruptly. So we've moved to one of those short-term extremes. So I wouldn't be piling into the gold market just at the minute. I think it'd be a much better reward for risk if we can get some short-term consolidation. Maybe just a bit of a pullback just to take the froth out of the top, because that froth has appeared, very, very quickly. So that's the precious metals market, and I'm just salivating at the opportunities in precious metals for this year. Other commodities, copper has done really well, up to $4.10. So it's taken off like gold in the last few weeks. Nickel eased back down. Copper possibly responding to the China reopening, but maybe just catch up, because as I was saying through 2022, I just didn't understand why copper was so weak. So perhaps this is just, the adjustment back again. West Texas Intermediate crude oil has bounced as well back to 80, and it's now back to the top of the trading range. So a bit of an interesting point for crude oil, where it goes to from here. There's the spot copper chart. You can see it's really taken off very, very quickly. And spot nickel just eased a little bit on the week. So wrapping up, I think this is a market to try and exploit short-term extremes. There's going to be plenty of them. They're probably going to arrive faster and sooner than would be normal. There's going to be lots of ups and downs. I think expect that the ups and downs may become larger, which is it's really good if that's what you're expecting and that's what you set up for, because it means that that you've got much more tradable bounces. I'd encourage everyone to really understand what it is in what you hold that is truly a long-term hold, and commit to it. If you own a portion of a stock that you're convinced is going to be higher over the long term, then continue to hold it as long as the fundamental case holds together. Because sentiment is going to turn sour on numerous occasions in 2023. I think that's what you have to expect. And as far as the rest of your portfolio and the cash goes, just be more active, buying and selling and doing it contrary to the herd. So when everyone is starting to smile and pat themselves on the back and how good things are, then you want to be turning pretty cautious and looking for reasons to take profit. And equally, when everyone gets fearful, then that's when you want to prick your ears up and look for opportunities to be buying. I just think that's the way that 2023 has got to be played. Portfolio analysts last week, we looked at sector relative strengths and just getting highly organised, understanding what your game plan is, getting your targets lined up, and then sitting and waiting and executing. It's not difficult, but it's something that most people seem to struggle with. And one of the things that portfolio analyst provides is that education and that perspective that can help people do that more effectively. That's it for this week. There's more information on the website. There's my email address, and I'll be back with you next Sunday. Cheers.